In their latest report, Bernstein says that Indian markets lack momentum. ET Now's Sajid spoke to Venugopal Garre, managing director at Bernstein. Listen into what he had to say over the sectors that could potentially help the market find back its growth.
I would say that there is an implied earnings recovery expectation built into FY27 numbers, which is this calendar year and beyond, compared to a fairly meager growth last year. So, from a perspective of not just growth, but also earnings revisions, which in our view last year would have bottomed out and started to settle at a certain level. What markets look for is not growth recovery, which is already priced in my view, but the drivers for earnings upgrades. Now, this is where, in my view, as of now, there's less visibility on what will drive earnings upgrades from here. And that's the reason why we ended up cutting India to a neutral beginning of this year with a positive returns expectations, but not a very large return expectation.
So what is the kind of earnings growth that you are expecting for FY27?
I mean, like most others, we are building in about 12% plus growth for next year. And on a CAGR basis, my target for Nifty assumes a 13.5% EPS CAGR over the next 2 years. The target is based on 2-year forward EPS. Now, that's, by the way, the best case growth one can build in over the next 2 years.
So you're building in a much better earnings growth in FY28 compared to 27.
Yes.
Can you also give us a sense of some of the data points which are there? Your report mentions about lackluster data points, which is plaguing the Indian market, and as a result of which we are seeing a lot of foreign outflows, which is happening for the last 12 to 14 months. How do you see this entire outflows? Of course, it's been supported by a strong domestic liquidity which is coming in from the mutual funds, but the valuation for the index remains at 21 times going forward, and that's been held on by the domestic flows.
Yeah, so in fact, last year was a pretty interesting policy year. We were anticipating a lot of sops for consumption, which is what essentially played out, which helped actually the economy recover from sub 6% growth to closer to 8% on real terms. Of course, nominal growth was lacking, but that was largely well understood over the last 12 months. But going forward, if I were to think of data points, pure macro perspective, I guess incrementally are lower. For example, even if you assume a rate cut, you can't assume a very large rate cut cycle. So we are more closer to peak of the rate cut cycle. Similarly, from a government policy standpoint, they have done a lot last year. It has led to some growth recovery, but not a substantive increase in terms of consumption spends, for example. So what can they do this year, especially when balance sheets are tight from a government standpoint, unless they raise fiscal deficit targets rather than keeping it on expected lines? There is no incremental growth lever expected to come from the government. And more importantly, India-US trade treaty, which is a much awaited sort of arrangement, has also got delayed a bit. We do anticipate that to get finalized this year because a lot of negotiations are going on. But only question that I have in my mind is that whether the treaty essentially holds good in terms of sustaining whatever the trade regime is discussed through the year. Will it remain volatile and keep changing through the year? So I would probably characterize it as bits and pieces of some positives, which can be eked out this year. But as of now, I'm missing that, that big swing up in terms of what can drive, the macro and earnings.
It's interesting that you spoke about what happened last year. You had the government cutting income tax, then the RBI cutting rates, and then there's a GST cut which also came in, which helped boosting consumption. But despite these three measures, we haven't seen the impetus to the earnings growth which was expected. Do you see that coming through in 2026?
The reality is, if you were to look at the construct of how most of consensus is building in earnings growth for the next 2 years, significant part of the growth is being assumed to come from margins rather than a top line recovery. Yes, top line recovery is being built, which is volume recovery, but bulk of your earnings growth is driven through margins, and margins still appear to be more closer to the peak of cycle rather than bottom of cycle. So in that sense, I guess what needs to be a very critical variable is an overall economic growth lifting up tremendously, and that could of course come through stimulus. It could be a fiscal stimulus, which could of course have implications with respect to yields and other external factors. It could also come from significant investments in India from a FDI route, which leads to some value creation in terms of capacity creation, for example. It could also come from, potentially AI actually leading to a positive spin for India rather than a negative spin, which essentially means more opportunities for services players rather than it impacting job growth. So there's a lot of things basically which are more ifs and buts for now, but from point of view of what could be that incremental driver beyond the recovery that is already being built in by consensus.
I was looking at your report, and you are bullish on consumer discretionary, but within that basket, you have moved out of Jubilant and then taken in Titan. Can you give me a reason? Do you see much more better consumer discretionary spends coming in for Titan compared to a Jubilant Foodworks?
See, essentially, the logic is very simple that we are relatively more positive on consumption versus industrials. That is a sectoral view we established last year in January. Now that holds good, which means we are underweight industrials and we're equal weight to marginally positive on consumption areas. Within discretionary, we're not overweight. We are selectively looking at bottom-up stocks here and there where we see opportunities. Not gravitating into stock specific discussion. It's essentially more a question of earnings momentum versus valuation, which is what drives our inclusion or exclusion of stocks. So the one that you mentioned has been included more in terms of relatively better valuations and growth compared to the other one. So that's the way we are playing. We're not like all buy on any of all the stocks in consumption, for example. Very specific on stocks or specific verticals.
How do you look at financials, private banks versus PSU versus NBFCs?
See, essentially, the pecking order still at this juncture is more private over PSUs on a 12-month view, while PSU aggression is a slightly more in the near term. But our order broadly remains this. NBFCs have played out quite significantly last year. So probably that will be number 3 in the list.
You have the budget which is coming in, Venu, and you're seeing some kind of revenue shortfall coming in for the government. How do you see the fiscal, math panning out, given the budget is just 2 weeks away from here?
Yeah, so see, I think the government will meet the deficit target of 4.4, even if that means cutting down on various revenue expense areas, could be subsidies or CapEx. Revenue shortfall is the way I approach it is remember that GST cuts were not factored in the budget when the budget was announced in February last year. So to that extent, it is an incremental impact on revenue collection. Any tax buoyancy that emerges from such sort of cuts is not immediate. It takes a while, for that to start to reflect positively on the GST side, and that while could be more than a year, could be 2 years perhaps. So from that perspective, I would probably say that revenue expenses and other line items, government is going to scrutinize very carefully. So we're not in a very large fiscal push environment. We'll probably meet the fiscal deficit by cutting spends. Going forward, however, the policy pivot will be very interesting to watch because next year we don't really expect any major consumption stops because a lot has already been done last year. So it is all about consolidating whatever we've done on consumption side and to see if some push to capex can be done. So we are penciling in 10% growth for capex next year. Our only sort of push in one of the reports we wrote is that government should ideally not worry about fiscal deficit and even if they keep fiscal deficit flat or maybe slightly above for next year and focus more on directing spending and re-energizing the economy till the time private sector starts to be more aggressive on spending, that will be a better strategy than pulling back on spends.
Do you see government, bringing down some bit of spending there because you still have that challenge of getting that nominal growth about 10%, and that's going to be one big challenge for the budget as well, because your revenues and your tax collections are dependent on that. And if you know there isn't much buoyancy in tax revenues, especially after the cuts that have happened last year, what is the kind of headroom that the government has to ensure that they follow the fiscal glide path they have already enlisted, and meet the street expectation on capex and other spendings?
There isn't much of a headroom. You rightly said, if your overall tax buoyancy is not that high, because see, all these things improve over time. We don't expect nominal to stick around the 9-10% level. It will of course eventually improve as a lot of activity levels in India improves, including on the private spending side of things. But in the interim, I guess the only way to pivot that is to ensure your pace at which you're cutting fiscal deficits, or the glide path as we call it, is moderated. uh, I would want fiscal deficits to be flat rather than be cut next year, so that there is some headroom for the government to actually spend without having to pull back on even subsidies, because that is also a very critical input for the economy. So that's where we are. It's more a 12-month thing, and remember that in another year or so, you'll have to also start budgeting meaningfully for the wage revisions. So then you are anyway stuck with that paradigm of having to budget for very large chunks, and then managing fiscal deficit is also a critical challenge. So best is to keep it high in the run up to that.
One of the biggest challenge which has been there is to get the private investments back, especially capex back. Do you see that reviving in 2026?
Reviving is a big word. Recovery probably is the right word. So we've essentially said bits and pieces of everything will happen. So you'll have a bits of revival in private sector capex as well, or rather recovery in private sector capex as well this year. See, private sector spends are purely a function of capacity utilization, which at the margin is still hovering closer to 80% or below. Private sectors are not out here to spend just like that. And more importantly, nobody likes private sector to diversify, add new capacities in new areas. So the reality is the equity market participants who actually own a lot of companies pretty much get very agitated when private sectors companies start to talk about investing. Everybody wants asset light companies, and they give higher valuations to such companies. So somewhere down the line, unless there's a need, private sector is not going to spend a lot. Private sector investments in infrastructure is an area which was a big driver for the economy after 2003 up till 2011-12. That may not return in the full sort of a speed as we saw that time, because a lot of mistakes were made, and so banks will also not lend that aggressively to that area, and not much of project creation is happening in infrastructure, excluding power, in the private sector area. So in that sense, some part of private sector spends will still be missing. So a lot of private sector companies will still have cash, which they will either return back to investors or hold cash, whichever ways.
Finally, if there are three things that you're going to be watching the budget for, key numbers or key policy announcements, what would those be?
I think fiscal deficit number will be very critical to watch as to how they navigate, whether there's any policy read from there. The second part is, will they budget for wage bill this year itself? Because that's been an area of doubt as to whether the typical 18-month time frame post formation of committee means, is it next year or this year? So that's the other part I'll watch. And the third thing, of course, I'll watch is capex versus subsidy, as to which direction the government is going to lead us to. These are the broader areas. I'm not really expecting any further tax cuts and other things at a personal tax level, so it's not really a watch out for me. It's always a watch out, but not something that I'm looking at closely this time.